Last month, the Reserve Bank put out a circular that offered the prospect of South African investors being able to escape caps on offshore investments. The changes allowed offshore assets to be treated like domestic assets if they are held by locally listed firms whose shares can be traded locally in rands. Today, the Treasury said it had suspended the circular to avoid what it called ambiguity around the rules. It said the prudential framework regulating vehicles such as pension funds remains unchanged. Now, I want to bring in Magda Wierzycka, for the eNCA CEO, on this issue. Magda, thanks very much indeed for talking to us. You saw this relaxation of exchange controls as a notable step, but today, effectively, the Treasury says, hold on, the limit on investment in foreign assets stays at 30%. That's still in effect. What's your take on it?
Look, I am bitterly disappointed because, when we saw the circular come out, I thought, there's nothing ambiguous. So let's be clear, there's absolutely nothing ambiguous about the circular. The circular basically said that particular instruments, exchange-traded funds, which track foreign indices and that are listed on the JSE, can now be treated as domestic instruments for regulatory purposes by institutional investors, by trusts, by partnerships, by companies, which basically meant that, within your retirement annuity or within your retirement fund, you still had your 30% offshore exposure that you could hold in any which way you wanted to, but you could also use portion of the remaining 70% to track on a very low-cost basis, track an offshore index. So effectively, you could increase your offshore exposure that way. And, if you actually look at the returns that South African savers have obtained from the JSE in the past decade, they are so substandard to what you could have gotten from overseas markets. So just to give you an example, over the last 10 years, the returns from the JSE Offshore Index have been 8.7% per annum. The returns of MSCI World Index in rands have been 18.7% per annum, which is a 10% per annum difference on a 10-year compounded basis. That is almost a 300% difference in returns. You would have been 3 times richer if you had been able to invest in these products within your retirement fund wrappers or within your retirement funds.
So let me ask you this, if I can just come in there. But one can understand why we have this caps to keep that money from not sort of bursting on the overseas climate scene, but perhaps just sort of keeping it inland at a time like this. What's your argument against that?
Well, why on earth would you want to? Let's look at the JSE and your investable universe on the JSE. So first of all, you cannot invest 100% of your assets in equities. Regulation 28 dictates that the cap on equities is 75%. So anyway, you would have to hold 25% in bonds, typically. And here, South African bonds are very appealing. And this is what most pension funds do. So we're talking about the 75% exposure. Now, if you look at the JSE, the number of investable shares, so liquid enough to be invested by retirement funds, is just over 40. 21% of the JSE is made up of effectively one share, Naspers, and process its proxy. Naspers is a wrapper for one Chinese company, Tencent. So 21% of the entire Johannesburg Stock Exchange is one Chinese share. So, if you talk about the concept of risk management, diversification, investing in a domestic economy, you're not achieving it through the JSE. You would be better off allowing investors to grow their wealth, feel wealthier, feel safer in terms of the security of their retirement, and hence spend more buying services from South African companies. Not rush into financial immigration, as many people are doing right now, in order to externalize their money. They would keep their money in South Africa.
Having said that, though, since the circular, my apologies for interrupting, since the circular, you would have had clients on your products that may have exceeded that 30% foreign cap. What happens to that now?
Well, what we've decided to do, since the circular has been suspended pending public comment. So public comment has been invited on the circular, and it's supposed to be in by the 15th of December. And here I would encourage absolutely every South African to submit commentary and to oppose the withdrawal of the circular, because I think the circular is to the benefit of all South African savers and to the benefit of South Africa. But what we have decided to do is, obviously, we have had investors who have taken advantage of this relaxation, and we will allow them to keep their assets invested offshore, those that have exceeded the cap, until such time as we have greater regulatory clarity, until such time as we know whether the circular will stand or whether the Reserve Bank and National Treasury fold to what one can only believe are vested interests that have made representations in order to protect their own financial interests. And here I'm probably talking about the active asset management industry, because who are the net losers of this legislation? Who would oppose this legislation? It can only possibly be people who lose out financially. So we are allowing our investors to keep their money offshore until such time as we hear otherwise.
Just very quickly before I let you go, I mean, your main argument in those submissions would be what, Magda?
The main argument is that, allowing South Africans, average South Africans, and, here we're not talking about wealthy South Africans, we're not talking about people who have already retired, because people who have retired can invest 100% of their assets offshore. So these are young people, people middle-aged who are accumulating their savings for retirement. You should enable them to maximize growth so that they maximize their wealth at retirement. They're not reliant on the state, so that they don't feel that they are constrained from, taking advantage of broad global diversification. And at the same time, we don't see how this is to the disadvantage of South Africa. In fact, even if you are afraid of the fact that money is being externalized and it would lead to a weaker currency, our argument would be that weaker currency would be helpful to South Africa's economy right now. It would help our imports, it would help tourism. So we need a weaker rand. In this pandemic, we need a weaker rand. So even if those outflows resulted in some externalization of rands and some weakness of the currency, not a bad thing. We don't need a strong rand.
Okay, thanks very much indeed, Signia CEO there, Magda Wierzycka. Thanks very much indeed. Now,